take our seats, please. The board members could come forward. Mr. Darby, we have an answer to your question. Mr. Junkin's going to provide it. Go ahead, Andrew.
Good morning. I had to check the time, sorry. Andrew Junkin with Wilshire. I believe Mr. Darby is speaking about our universe comparison where we stack CalPERS up against other peer funds, and on one of the measures is the allocation to U.S. stocks versus non-U.S. stocks.
He's shaking his head yes.
Yep, okay. That's a report that we're bringing back next month. We weren't passing judgment that it was right or wrong. It's just a difference between you and many of your peers. You are relatively overweight non-U.S. stocks compared to U.S. stocks because of the decision of the board to invest on a global basis. So he's correct that there has been some performance impact, but we were not saying that's right or wrong. That's just how you are, and here's how you stack up compared to your peers.
Okay.
Mr. Chair, before we start agenda item 9B, can I take a moment to acknowledge one of our global peers and one of the thought leaders in the industry, the CIO of CalSTRS, Chris Elman's here today in the audience with 10 of the student interns of the summer. So welcome to CalPERS.
Welcome, Chris. Thanks for being here.
You know, you're my retirement system.
We got you covered.
With that, back to you, Mr. Chair.
Okay. Anything else, Mr. Junkin?
I suspect you probably want me to do the consultant report on 9B.
Correct.
Okay.
I didn't know where we were starting, so is that where you want to start, Mr. Meng?
Yes. So here's your primary investment consultant, Wilshire, will provide a performance report, followed by Makita and the Pension Consultant Alliance to provide comments specific to private equity, real assets, and the infrastructure.
Very good. Thank you. Mr. Junkin.
Great. Thank you. I think I said this earlier, but I'm Andrew Junkin with Wilshire Consulting. At 9B, we actually have two attachments, and so I've got 99 pages to cover. Two of those pages are title pages, so really it's only 97. So should be fine. I'm going to go pretty quickly. Staff has already covered a lot of this. We sort of take turns who goes first. So I'm going to try to pick on some spots where I think there's some differences and not just try to reiterate the same things that you've heard. Thank you. This chart is a little bit hard to read here on page 2. This is our June asset class assumptions. We update these every quarter. These are 10-year forward-looking assumptions. Really, the couple of things I wanted to draw your eye to. One, the expected returns for equities on a forward-looking basis continue to come down. So one way to think about that is as the market has continued to go up, and for most of this year it has, we would argue that the price is probably going up faster than the fundamentals are. If they'd sort of gone up in lockstep, then we'd see that the expected returns haven't changed. So you're kind of pre-earning, if you will, some of the expected return over those 10 years early in these last 2 quarters, and that's dragged down the expected returns. Private equity, our expected return there is down to 8.35, which I think is the lowest that we've shown. Spend just a quick minute here on page 3. I was impressed that we made it as long as we did without talking about the yield curve inversion, so there should be a prize for Ms. Taylor for bringing that up, I think.
Okay, what is it?
I don't know what the prize would be. Well, maybe it's this comment that in addition to the yield curve inversion, we also had a brief patch last week where we had negative yields on the 10-year tips. And so you really were in a state where, you know, the market had just said, give me most of my money back on an inflation-adjusted basis, and that's good enough for the U.S. economy. So I think that says a lot about what the market thinks about the strength of the U.S. economy, but also the global economy. The break-even inflation point, so the difference between the nominal yield you could earn on traditional treasuries and the yield that you would pay on tips was about 1.6. So that's not a lot of implied inflation over the next decade. One other point, that with as many newsletters as were issued last week on inverted yield curves calling for the beginning of every recession, the New York Fed actually publishes a probability of recession, which is just based on a regression of a number of metrics. Right now, it's at 31%. It's never hit 40 and not predicted a recession. And there's only been one other time going back 50 years where it's been as high as 31% and not predicted a recession. So I think the market, the bond market and statistics would say it's a challenging time. Sorry, I've got my notes in a couple of places, and I've been sort of deleting as I go so I don't repeat staff. Here we go, page 7. So using our forecasted returns, which I just showed you on page 2, and your asset allocation, these are the forecasted returns that go with that. In addition to the 10-year forecasted returns, we have 30-year forecasted returns. So the first 2 bars here, and I'll just focus on the target allocation, show the forecasted returns over the next 10 years and over the next 30 years. Really, 30 is most meaningful for you. That return is still 7.25, but the next 10 years come in below 6%, 5.9. Skipping ahead to page 10, here we've got total fund performance broken down by asset class. Staff has already covered, I think, a large part of this, but I did want to point out that, as was noted during the conversation about attribution, private equity has been the best performing asset class. And so that is really one of the reasons that you continue to allocate to it. You can see it in our expected returns. It's still 2.5% essentially above public equity. So it does play a significant role in most institutional investors' portfolios. We'll talk a little bit about most of these asset classes as we go. I think Eric's really covered private equity and the implementation of the factor approach there. The timing was great, as he mentioned. The focus of the factor approach, leaning on low volatility, worked as expected, worked better than expected. So it's nice to get off to a good start. I would encourage you all not to expect 800 basis points of outperformance from that strategy on a yearly basis, as Eric mentioned. We'll talk a little bit about real assets in more detail since there was some performance detracted there. I was going to spend just a minute on this attribution since there were some questions earlier about how does this work. I think most of them were covered, but I try to break this down pretty simply. By asset class, what is the actual weight been over the last 12 months? So it's actually an average of the last 12 months of weights. That's the first column. What's the return? The benchmark, what's the weight? And it changes over the last 12 months because you've added asset allocation changes. So that's why some of those numbers look a little weird, like 41.41%. That's not really your target to public equities, but that's been the weighted average of the target. And the return. And then you can see the next 2 columns, differences. That's just the mathematical difference between the weight columns and the return columns. And then you do some multiplication. The last 3 columns really are what matters here. What's driving the return difference between the policy benchmark and the portfolio? And you can see you underperformed, if you look at the bottom, by 42 basis points. And that was split 29 basis points due to actual allocation and 13 basis points due to active management. So actual allocation, if you are underweight an asset class that does really well, that's a drag on return. If you're overweight an asset class that does really well, that's a positive to returns in attribution space. Flip that around as well. If you're underweight one that does poorly, that actually adds to your returns from an attribution standpoint. If you're overweight one that does poorly, that's a drag. And then active management is, did you beat your benchmark within that asset class? So as you scroll through here, you can see the allocation effects are really pretty small. The 2 that jump out, private equity for active management was a pretty significant tailwind, adding 25 basis points at the total fund level, and real assets detracted 34. And so we're going to talk about that in a few more pages. Any questions on that? I know that was a really quick flyby of the attribution. To me, it's kind of a report card. What do we need to dig into further? Okay.
Yep, seeing no other requests, thank you.
Okay. Let me just jump to a couple of pages that we normally cover. So page 26, private capital dry powder here. This chart, you have to really pay attention to the scale. The scale's gotten pretty significant. There's $2 trillion with a T sitting on the sidelines waiting to be deployed in private asset classes. 1 trillion of that is in private equity. It's been committed, but not yet invested. So this says a lot about the private market landscape, right? It is very competitive right now. If you were selling a business to a private equity investor, odds are you're going to get a pretty good price because you're probably going to have a line of them around your office waiting to deliver their bids. So that's one of the challenges in this space for investors, and one of the reasons why our return expectation to private equity is as low as it's ever been at 8.35%. There's so much competition for these assets. Go to page 28. So here's the corresponding chart that goes with it. This is private equity pricing, covering a similar time period. You can see we were at about 9 or 10 times before the financial crisis. That dipped to kind of 7 times after the financial crisis, and now we're back up to what is an all-time high of 11.2 times for private equity deals getting done in the buyout space. Let's see. I think we've talked plenty about interest rates. Let me just jump to real assets quickly. So page 41 here, the fundamentals behind real estate, the 4 large sectors here. The red line is essentially the vacancy rate. And fundamentally, vacancies are still down. So the real estate market is pretty healthy from a rent standpoint. If we jump ahead to page 44, here you can see the performance, and I'd just draw your attention to the 1-year number, 3.7% for real assets, 6.5% for the benchmark, so some underperformance. So what happened? Well, one number that's going to jump right out at you is forest land. And as you know, there was a big piece of forest land that was sold about a year ago, so it rolls into this fiscal year's performance. There was a markdown, and that explains most of, if not all of, that underperformance for forest land there. Within the real estate market, some of the disparity came from your treatment of malls versus the universe or the index's treatment of malls. And when I say treatment, there's some decision to be made about how often an appraisal is made and how that flows into the valuations. And I would argue that you all were pretty aggressive on pricing malls in that, as I don't mean aggressive like inflating, I mean aggressive in terms of writing it down quickly and facing what you thought was the truth in terms of mall pricing. And the index, which in this case is an index of peer funds, has been a little slower to write down malls. So this is one of the tricks that you have to be careful with on private asset class performance. Shorter term time periods don't mean quite as much, right? So I suspect, and we'll see if I'm proven correct, that there will be some continued write down on malls at the index level, whereas you've really kind of taken the bulk of the hit. I think you'll see that mall section sort of become a relative tailwind over the next 6 to 12 months. And then the bit of good news on the page is not forest land, definitely not forest land, sorry. Infrastructure, I read the wrong word. With, significant outperformance over the last year, but over every time period, that's been a huge win for a portfolio for CalPERS. One last thing I wanted to cover before we moved on, and this goes back to the TLPM strategies. So we're reporting on a number of strategies here. There's some really weird numbers on this page that I thought it was worth highlighting. So I'm looking at the TLPM risk mitigation strategies. You have $200 million exposed to those strategies, and you can see down 82%. That seems awful. Remember what those are there for. They are sort of tail risk hedging strategies. In normal markets, or in markets that are slightly up or slightly down or even massively up, those strategies aren't going to do well. But there could be a day when the market is down pretty significantly, and we come in and we report that the risk mitigation strategies are up 1,000%. It's possible. So I just wanted to point out this one odd aspect of the portfolio, because that's a big number in terms of the performance. It's a very small number in terms of the dollar values, but I wanted to call that out in advance. So when the day comes, there's a huge number. Somebody says, why didn't we do more of this? It's sort of an insurance premium. You pay a little bit when the market's normal, and then when the market sells off, it should help support the fund. And I'll finish there. Happy to take any questions.
Mr. Perez.
Thank you. So if your projections, the 10-year projections and so on, if they are without fees, is there any way to determine what that would look like for us?
So the management fees for you for the bulk of your portfolio really would be, the bulk of your portfolio has very little management fees because it's internally managed. That's the way to say it. Domestic, public equity and fixed income is all managed internally. Where the bigger dollar value of fees is in private equity in particular, and to some lesser degree, real assets. Our assumptions on private equity, we make the concession that you cannot invest in that asset class on a no-fee basis. All of the other things are essentially no fee. So what we assume there is that you're going to get top quartile returns net of fees. And that leads to that 8.35%. So it is, in that case, that's how we try to address the fee issue. So I would say that the forecast that we showed, that number just right under 6%, is essentially net of fees.
Okay, thank you.
Ms. Yee.
Thank you, Mr. Chairman. So your calling out of the risk mitigation strategy just had me thinking about a couple things. One, I guess from your perspective, how well the total fund is positioned to withstand an economic downturn, and are there additional measures that we ought to be thinking about? In addition to the ones we've already taken?
Yeah, I think Ben made the point right before we broke that you've spent a lot of time and done a lot of work in this area, and you're better positioned than you were in 2008. And I agree with that. I think one of the big levers you had left to pull was the implementation of the low volatility equity strategies, and you did. That was the biggest one that was obvious to me. I think at this point, really, if you're not comfortable with your downside volatility, the big lever left is to take equities out of the portfolio, or reduce, right? I don't mean completely. But then you start another whole conversation about what are we doing to the discount rate. And so that's a bigger issue.
Right.
So tactically, are there other things that you could be doing to mitigate drawdowns? I really think there's been a whole body of work done here within the TLPM group, and really you've taken a look at everything that is possible, things that are possible theoretically, in some cases are not possible because you're CalPERS and because you're trying to hedge, $180 billion worth of public equities, and that is too big a number in some cases. So the answer is you've done as much as you can, but you still have a lot of equity risk in the portfolio that you just can't escape.
Right. Okay, thank you.
Ms. Olivares.
Thank you, Mr. Chair. I'd like to better understand the makeup of the custom volatility premia benchmark and why the divergence between the results and the benchmark.
I am honestly going to have to ask Eric Baggeson if he can explain that benchmark, because it's one of about 150 benchmarks that get plugged into the performance system.
So I'll start. I'm still wearing the MID of Global Equity hat also, and we manage that internally. It is basically a set of factors that we use. Andrew highlighted volatility. There's also some various other things that go into that. That basically the idea is to try to, as Eric said earlier, capture the equity risk premium. So capture markets, get something like full upside capture while mitigating the downside capture. So trying to get lower drawdown in a down market. We can go as deep.
I assumed that. I guess, can you explain the divergence then?
The divergence between the
So
two.
I'm looking at the benchmark here, and it looks like it's negative 5.8% for the 1 year. Are we seeing that in terms of performance too? So, I'm sorry.
You're talking about cross-asset volatility premium. So you're talking about the trust level. So that's not the factor-oriented portfolio.
Mm-hmm.
Yes. Can you speak to that?
Yeah, bear with me one second. I'm just trying to catch up with your question here. Let me see the material. Yeah, so what you're seeing with the cross-asset volatility premium, in other words, this is literally just an exercise or a trial portfolio where we're attempting to see, can we, in essence, sell volatility and do that in a profitable way. And what you're basically seeing is that effort, over the past year and over the past quarter just obviously did not work, but there's almost, it's a de minimis amount of money that's deployed into that. But it's, I'd have to check with Ron Lignato, who's the person in TLPM that really runs that. Honestly, I just don't have the detail as to what makes up the benchmark for that negative 5.8%. We can respond to that question to you after the fact and give you a response to that.
Thank you.
All right, seeing no other requests? Anything else? All right, Mr. McCourt.
Good morning. Steve McCourt with Makita Investment Group, your private markets consultant, real estate, infrastructure, and private equity. I'm going to go through our reports that were provided in your packet under attachments 3, 4, and 5. I'm going to make some high-level comments on each category, and I also have behind me, to save me for any tough questions on real estate and private equity, subject matter experts at Makita as well, David Glickman on real estate and Steve Hart on private equity. So I thought I'd start with just a very broad context that's been mentioned a few times before, which is the level of interest rates in the economy. And I bring it up in the private markets realm because at the end of the day, long-term interest rates and the level of long-term interest rates in the global economy is probably the most fundamental factor that drives forward-looking returns for all asset classes, including private markets. So when interest rates go down, it has generally the impact of elevating the prices of assets immediately, but then reducing the forward-looking return of assets, which is what Andrew had described. So all three of these asset classes in different ways have benefited from the decline in interest rates over the last 10 years or so. Just looking at the last 5 years, where global equity markets over the last 5 years have returned roughly 7% annually. Bond markets are up 3 or 4% annually. Your private equity portfolio has returned nearly 10% per year over the last 5 years. Your infrastructure portfolio, nearly 13% per year over the last 5 years. And your real estate portfolio, 7.6%. But if you X out the legacy assets in your real estate portfolio, your core real estate portfolio is up over 10% per year over the last 5 years. So all private market categories have done really well over the last 5 years, and that's partly due to the fact that lower interest rates encourage investors to invest in things other than bonds, as bonds yield less and less and less. So these asset classes, like public equities, like high-yield bonds and other credit instruments globally, are really highly priced today, and that's just a reality that the board should be aware of. As evidenced by the returns, the execution across these three categories has been fairly strong over the last 5 to 10 years. The challenge, though, I think will be similar across all three, which is how to deploy assets at scale in a way that maintains a reasonable level of expected return without expanding the amount of risk significantly that you're taking. And building on Andrew's comments around how you're positioned today versus 2007, the one thing I'd want to make sure you walk away with from a structural perspective is that all three of these programs are very well diversified by property, asset, geography, and manager. And in the case of real estate, your portfolio today is largely invested in much more economically defensive core properties than it was 12 years ago. Your infrastructure portfolio is predominantly invested in core defensive infrastructure properties. So to date, staff has done a nice job maintaining and building on the focus of these programs being on the more economically defensive side of the spectrum of how you can build various private market programs, and we would encourage staff to continue in that endeavor at this stage in the economic cycle. I'll start with, in terms of a couple of comments on each of the programs distinctly. I'll start with infrastructure, which has had for a long time now really, really strong returns. Arguably, this is the asset class that's benefited most from the decline of interest rates because many global investors view infrastructure and core infrastructure in particular as a substitute for long-term bonds. So when our 30-year Treasury bond becomes yielding less than 2%, one can justify a much higher price on long-term contracts that have cash flows that exceed that. Your returns, that being said, relative to anything I've seen in the marketplace are just in the stratosphere. 17.9% for 10 years in infrastructure is unheard of in the industry, and your staff should be committed for that. The other thing I want to highlight, when we came on again a couple of years ago as your board infrastructure consultant, one of the issues we highlighted was the pace of investment in infrastructure. Returns are great, but they don't really move the needle unless you can kind of increase the scale of the program. Staff's done a nice job in the last couple of years of taking action to accelerate the pace of investment, again, without unduly increasing the risk of the program. On the real estate program, I want to highlight and reinforce Andrew's comment earlier on the retail space of real estate. While most of real estate has done well for many years, for the last couple of years, the retail space has been challenged by what's largely referred to as the Amazon effect. And retail, represents a meaningful allocation to many core institutional real estate funds. Your staff and their separate account managers have been responsible in pricing retail assets appropriately as cash flows and values of retail properties decline over time. The rest of the industry is not, for agency reasons. Many commingled funds that own retail properties are averse to reducing prices before they absolutely have to because they're competing in the marketplace for customers. So from our perspective, your staff has been responsible in that regard and has sort of at a broader level continued to do a really nice job orienting the portfolio towards more of a core income-producing real estate portfolio from where it was a decade ago. Final comments I want to make on private equity. Your private equity portfolio represents just a tad over 7% of your overall program today. As we've noted before, probably the biggest challenge in your private equity portfolio, much like infrastructure, has been getting more dollars out the door invested. To give you a sense of the scale of that problem, and I might put quotations around the word problem, since 2011, your private equity program has returned back to you $33.6 billion in gains, above and beyond the capital you've given back to managers to invest on your behalf. It's really hard to keep your allocations up when the flow of capital coming back to you is at such scale. And that's something that has impacted many institutional investors, and your staff has started to react to that by elevating the amount that they're committing to private equity, and as you know, looking at initiating at scale co-investment opportunities as well. So we're very pleased to see the pace of commitment increase over the last year, which is a nice step forward, and look forward to more deployment from there. The returns of the private equity portfolio, staff went through a little bit. I just want to highlight a couple of items. As was noted, for the last year, the private equity program returned 7.7%, which exceeded the new benchmark by a little over 3 percentage points. CalPERS, and this is not unusual for many institutional investors, periodically changes its benchmarks for a variety of reasons. And not unusual given human behavior, often those benchmark changes are made not at the best time. And so what ends up happening was when you link together a number of historical benchmarks, that linked benchmark has a much higher return than any of the legacy benchmarks that you used historically. And so I just wanted to highlight that over the last 10 years, your private equity portfolio has returned 14% per year on average over that time period, which is roughly in line with the new current benchmark over that time period, the FTSE All World Plus 150. Your policy benchmark returned 16.5% per year over the last 10 years. Because, as I mentioned, it's a composite benchmark that glues together several benchmarks that you had. There's literally not another usable benchmark in the industry that has a return as high as your historical policy benchmark, because that benchmark was changed at a time that wasn't propitious for you. And that just happens sometimes when you have a benchmarking policy where you don't retroactively change your benchmark, you simply append it to the legacy benchmark. So I wanted to highlight that as we have in the past as well. In our report, we get into a little bit of detail on areas that have done well, areas that have done not as well. I would summarize those comments that you've generally done well in over the long period of time that we're looking here in co-investments and funds, not as well in fund-to-funds and secondaries. And you've done better in core traditional private equity sectors like buyouts, and less well in credit strategies that you've invested in historically. I also want to highlight that private equity is about, depending on how you measure it, 60 to 70% U.S. focused. So while it's a global asset class, it is a little more tilted towards the U.S., which also gives it a little more defensive characteristic, given what's going on in the world today. And my final comment, is with all the private market categories, I would suggest a degree of patience with judging performance versus benchmarks, because, as was noted before, short-term benchmark comparisons can be very lumpy for valuation reasons. And more importantly, because these are not publicly listed prices for assets and they're subject to valuation, you really don't know what your return is until the cash is returned to you. And in closed-end funds, that cash doesn't get returned to you for 7, 8, 9, 10 years into the future. So to look at performance shorter than that, what you're really looking at more is valuation policy than you are actually actual return. The returns that you see on these pages are, for the most part, time-weighted rates of return, where if we were to do a deep dive into specific sectors or strategies, we'd be looking at internal rates of return, which would make the numbers change a little bit as well. So just all reasons to take relative performance with a little more patience than with the public markets. And that concludes my remarks.
Excuse me. Thank you. Seeing no requests. Anything else on this item? Andrew?
I neglected to mention that Treasurer Ma requested information on the affiliate funds. That's in the second 49 pages of our report. It's from about page 25 of attachment 2 on. We report every 6 months on every one of the affiliate funds. So if you could pass that along to her, Matthew, I'd appreciate it. Thank you.
Thank you.
Okay, now, Mr. Chair, it's item 9C.
9C, very
Yes.
good.
So where we seek your review and direction on the proposed update and revision of the total fund investment policy.
All right. Thanks, Ben. So this is item 9C. As Ben said, this is a first reading of potential changes to the total fund policy arising out of this year's review of our policy, intending to maintain an accurate, current, and relevant policy framework. Joining me are Kit Crocker and Beth Richtman, and then also we have other members of staff. If we get into deep questions, this definitely is an opportunity for feedback from the investment committee on this proposed policy. So this year's review generated changes in 4 main categories. First of all, strategic asset allocation. Secondly, the total fund leverage management, a refresh of our governance and sustainability principles, and then finally some ad hoc changes. Regarding strategic asset allocation, and this was referenced earlier and to Mr. Jones's question, it was really about implementation of the asset segment work into the total fund policy. Regarding total fund leverage, and again to Ben's previous comment, it's about migrating to a centralized total fund leverage governance framework using an aggregate limit of 20% as opposed to the historical disparate asset class limits around leverage. The third main change, again, is the governance and sustainability principles, and this draft reflects updated language on board oversight of such things as corporate culture and labor practices, disclosure of such activities around lobbying and then workforce demographic data, and then finally a refresh of our philosophy on executive compensation. And then finally, I'll just highlight the most notable of the kind of general ad hoc changes, and that surrounds prudent person opinions, or PPOs, and the thresholds below which they will automatically be required for certain private market transactions. So as mentioned, this is a first reading. We're seeking the committee's feedback and questions, and I'll pause there. Mr. Chair, I'll turn it back to you. Happy to certainly take any questions or to hear what the consultants have to say, whatever is the pleasure of the
We have no
committee.
questions yet, so let's hear what the consultants have to say.
Good afternoon, Ali Kazimi, Wilshire Associates. I just wanted to address the first reading of the proposed policy changes. As Dan mentioned, there were approximately 90 changes that were reviewed. Majority of those, around 80% of those, were low in terms of their material nature. The area that we really kind of focused on had to do mostly with the leverage centralization that will be housed within the TLPM team. Leverage has, from a risk standpoint, the ability to really move the dial, and so we really wanted to focus on what those changes were. We agree that the centralization makes sense from a policy standpoint, and these changes are appropriate. The one area that we discussed with staff was the removal of an appendix that had the leverage limits within the asset classes. We felt that those, as the policy was being constructed, that removing that would be potentially inappropriate for a time being. So the decision was made to move that into an investment policy and procedures guideline, which still is under the purview of your consultant. So with that change included within this first reading, we are supportive of all of the changes in the policy document and are happy to address any questions.
Thank you. We have a list of questions now. Ms. Ortega?
I just wanted to talk a little bit about the change on the leverage. So I understand the point about centralizing it. I understand that completely. What I would like a little more clarification on is if the result of this change to centralize is going to change behavior in terms of the use of leverage and the types of strategies that might be employed, because I'm kind of losing that nuance in the way it's being characterized.
So as Ali mentioned, so the expectation would be no, other than to think of leverage through the total fund context. Much of what Ben is working on is looking at liquidity through the total fund context, active risk through the total fund context, and leverage is another one of those. When you view these topics from the bottom up, they tend to come together in a suboptimal way, as opposed to when you view them from the total fund down. So that would be maybe the change that we would expect. It would be a more optimal use of leverage. However, to Ali's previous point, by including the legacy leverage limits within the IPG framework, so that's what comes to the board consultants, it just doesn't come all the way to policy, we would expect that the limits will still be maintained, but there would be a more optimal use of the leverage by moving to centralized.
Okay, thank you.
Mr. McCourt, did you have something to add before we take the other questions? Okay. Ms. Yee.
Thank you. The changes to the benchmark modification process, I guess I wanted to just get a sense of what this committee can expect. So will that reduce the number of changes that will be brought before this committee, presumably? And then I just had a question about how you define a material change for this purpose.
Happy to address that first. So we reviewed those proposed changes in terms of what would come before the committee and what would not. We felt that those were all reasonable from our perspective, and so we're supportive of those changes.
And then I guess, how would you define a material change, I guess, within this context?
As the person who signs all of the benchmark change forms from Wilshire, I decided I should probably jump up here. I don't think that we have a rigid set of strictures that we use to define materiality when it comes to a benchmark change. It would be a significant change in either the risk or the expected return profile of the benchmark, or if there would be a significant cost to implement it. So, for example, if you decided to change equity index fund providers and it would cause, I don't know, 30% turnover in the portfolio. I'm trying to make something up that almost can't happen, but result in no significant change. Why create all these transaction costs that you're never going to get paid back for? So the way that process works, and to address one of the questions that you asked earlier, is this going to change the number of benchmark changes that you see? It's not, because you only see the material ones.
Okay.
Everything else comes to us, and we can either kick it back and say, no, we believe this is material and needs to come to the board, or the investment committee rather, or, yeah, okay, you're just changing the ticker on this benchmark for this reason. That's administrative. We sign off on it. It goes to State Street. It's implemented.
Okay.
Does that
So
help?
you're kind of memorializing what you're practicing.
Yeah, I was about to say that,
Yeah.
that absolutely, that what you've had in the past is we've been relatively silent on benchmarks, and we've been engaging in these practices, but we haven't had them codified in policy.
Yeah.
The idea here is to actually memorialize them in policy so that we're aware of what will come to you. And again, though, there is some judgment applied between staff and specifically
Sure.
your independent consultants on whether this is material and needs to come to the board, or whether this is something that more falls within the purview of it doesn't change the expected risk and return parameters, and so we think we can just do this as a ministerial change.
Okay, that's great. And then just as an overall matter, very appreciative of the inclusion of the carbon pricing language, which is getting a lot of national and global attention. So thank you for the work on that. And then the other changes that expand the financial reporting provisions, I think, are really strong as well. So thank you for the work on that.
Thank you. Ms. Brown.
Thank you. I have I think it's a simple question. On page 23, there's a small change to the TAP investment program, and maybe not. Maybe it's just a numbering that changed. It says, now you refer to table 6 as opposed to 7, and I just want to make sure that it's just a renumbering is all that's happened to the TAP. That we're not changing the way we invest in the money in the TAP, or if we are, we're not making it more conservative. And I had to look at the second attachment they had that showed the changes.
I'm sorry, Ms. Brown. Can you?
I think it's 9C, attachment 1, page. It's either 23 or 25. I can't read my own writing, so hold on. Let's see. I just want to make sure we're not doing anything to the TAP. If you want to tell me that, I'm happy with that.
There's no asset allocation change to the terminated agency pool, and it couldn't
Right,
it couldn't be made more conservative since it's fully immunized.
Right. I would hope we would make it less conservative. It's item D. It says restrictions, prohibitions, and authorized securities.
I'm on that page. Yeah.
So it says now it's Appendix 6, and then the change, it used to be Appendix 7. So I just want to make sure nothing's changed in that appendix. I don't think so, but it's a very big report.
Kit Crocker, Investment Office. I believe it's just a change in the numbering of the appendices because we eliminated one appendix.
That's all I wanted to hear.
Connected with leverage.
Yep.
It was hard to figure out on my own. Thank you.
Yeah.
All right. Anything else, Ms. Brown?
That's it. Thank you.
All right. Seeing no other requests. Anything else on this item? Very good. Thank you. Brings us to 10A. Consultant to review of trust level management. Mr. Junkin, Ms. Dean. Oh, pardon me. I have 2 requests from the audience, Ms. Sarah Theis and Neil Johnson. You both please come forward, identify yourself for the record, and you'll have up to 3 minutes for your comments.
Hello, my name is Sarah Theis. I am a board member of Fossil Free California and a CalPERS retiree. And as you know, I like to take advantage of my 3 minutes every month to raise a few things I've seen in the press about what's going on in the fossil fuel industry. This is relevant to our agency's mission regarding the dangers that fossil fuels present to the future of the planet, and it's relevant to me personally in terms of having an interest in the pension fund being funded as well as possible for my retirement. So just a couple of things. You are all probably aware, this was alluded to in the discussion about problems in the energy sector. This is a particularly bleak financial outlook for the U.S. fracking industry. The losses continue to pile up. Shale companies are dropping in value. The debts continue. And basically, there's also a problem that they're running out of good rock. So the future of that industry is even worse than you would think. Given this, it's not surprising that exploration and production bankruptcies are on the rise as oil and natural gas prices are not doing well. One particular leading light in the industry said some stakeholders have given up hope that resurgent commodity prices will bail everybody out. Given this, I found an article headlined, "As Risky Finances Alienate Investors, Fracking Companies Look to Retirement Funds for Cash." So it is my hope that, and I know everybody, the staff has been talked about in this meeting, thoroughly do their homework, that we won't be investing in that. One Pioneer Natural Resources CEO, Scott Sheffield, recently told, I think this was the Wall Street Journal, "We've lost the growth investors. Now we've got to attract a whole other set of investors." So those are my, they're planning on getting 40% of their capital for 2019 from private equity funds. So I'm just drawing your attention to these issues, which I think are just little benchmarks, so to speak, or signs in the what's the actual future of the oil and gas industry, which in my opinion is not good. So thank you so much.
Thank you. Mr. Johnson.
Neil Johnson. I'm representing SEIU today. Chairman Thechner, members of the committee, I thank you for your work on this important item. SEIU firmly believes that the systemic risks in the economy really need to be looked at with respect to sustainable investment. We support most of the recommendations made by staff in the redrafting of this item. They really reflect your fiduciary responsibilities. Specifically, we like the calling out of corporate boards to take steps to ensure healthy and safe and transparent corporate cultures, implement real compensation strategies that value the work of the workers, not just the top echelon managers, the data disclosing lobbying efforts, increased disclosure on demographics and diversity within the organization, and really truly integrated financial reporting, and what are the potential human capital and risks, and particularly what are the climate risks. We are supportive of the work, are the comments made by staff with respect to incorporation of environmental risk factors and labor practices. So on behalf of the 2 million members of SEIU and our leadership, we thank you for continuing your role as a real fiduciary and leader among pension funds. Thank you.
Thank you for your comments. Brings us to agenda item 10A. Mr. Junkin, Ms. Dean.
Mr. Chair, so in agenda item 10A and 10B, you will hear from your primary investment consultant, Wilshire, to cover the annual program review of 2 trust-level investment programs, which is the trust-level portfolio management program, as well as the Opportunistic strategy program. The annual program review of the other 4 major asset classes, global equity, global fixed income, private equity, and real assets, are to be covered in the following month. With that, I turn over to Wilshire.
Ali Kazimi, Wilshire Associates. So as Ben alluded, these will be the first of several opinion letters that you will be receiving from your board consultants on the various teams within PERF. Today, first we're covering the trust level portfolio management team. The purpose of the opinion letter is really to provide a summary of the due diligence that we perform on the various CalPERS teams. And it's similar to what we would perform on any investment management organization, third-party organization. The goal of that due diligence is really to help evaluate whether TLPM is organized to be a value-add contributor towards CalPERS' long-term objectives. And so I think it's worth reiterating some of those objectives. One is generating a return that exceeds the actuarial rate of return. Secondly, employing meaningful diversification throughout the portfolio. Maintaining compliance with the asset allocation policy ranges, as well as ensuring adequate liquidity. And then lastly, generating positive excess returns through active allocation decisions. So in our review with staff this year on TLPM, it was clear that the recent emphasis on total fund performance has had a material impact on TLPM, as that group has had its mandate expanded from 3 core functions to 5 core functions. The previous 3 functions were in relation to strategic asset liability management, dynamic asset allocation, as well as portfolio strategy research. The new additional functions relate to the investment manager engagement program, which has now been centralized within TLPM. And so that's the team that manages external manager selection process, including the emerging and transition manager programs. The fifth addition to the core functions of TLPM include the integration of the total fund business and analytical services team. So that team delivers business, analytical, and administrative services to the investment office and throughout the enterprise. Wilshire feels that this expansion is consistent and makes sense with the emphasis on total fund performance, and it makes sense to warehouse that within TLPM. However, we do want to note that anytime you have change within an organization, that can create some short-term uncertainty. And that was one of the things we did discuss with staff, as some of the projects within TLPM were reprioritized as part of some of the new functions of TLPM. We think that's natural. We just think that as the vision of the CIO is implemented, maintaining strong communication as part of that is appropriate to appropriately manage any issues with uncertainty. In terms of our scoring for TLPM, it's actually detailed in the memo. As I mentioned at the onset, we compare CalPERS to any investment management organization out there via this qualitative framework. It's consistent with how we evaluate all managers. And rather than step through every component of the scoring, I wanted to just highlight some of the strengths and then some of the areas for potential improvement. First and foremost, I want to discuss, the firm score. Relative to last year, there have been some changes overall within the firm, as everyone is aware. So part of that is Ben's hire and his inclusion now in driving the overall vision of the team. We view that as a positive, and for that we increased the score overall from a firm standpoint. But it also did reflect the overall score, the departure of the COIO over the last year as well. So there was some positives and some negatives overall with regards to the firm, but overall the score did increase. Team score didn't change with regards to just the TLPM team. We addressed earlier today the discussion about staff size within the TLPM. That has increased over the last year. A lot of that increase has to do with the expanded functions that I mentioned earlier on. And so we feel that the team is certainly adequately staffed to support all the initiatives that TLPM is currently working on. In terms of information gathering, Eric talked about it during the discussion this morning about the examination of active risk within the overall portfolio, and that being centralized within TLPM as part of the portfolio research function. We were very impressed with that project and how it's being implemented. Looking at active risk holistically at the total fund level makes a lot of sense for multiple reasons. And so for that, we increased the depth of information score within the research category. From an implementation standpoint, over the last year, the new asset allocation was implemented. We felt that was done in a very organized and smooth process. For that reason, we also increased the score from an implementation and trading standpoint, and that was reflected in the overall scoring framework. The last strength I wanted to highlight was the overall emphasis on attribution. Ben mentioned that at his first presentation in January at the offsite, that attribution is going to be a big component of measuring performance throughout the fund. You really can't manage if you don't measure properly. And so that emphasis on measuring, using attribution is something we are fans of and we definitely support. And so for that reason, we increased both scores with regards to attribution, and it's something we'll continue to monitor going forward. In terms of areas for improvement, the only area that there was a slight degradation in the score was with regards to forecasting success. That category, when Andrew looked at the attribution in the review, one of the areas we saw is a slight decrease in performance, about 9 basis points, coming from the external strategies that are in the TLPM program. And so that highlighted some of the challenges in regards to tactical asset allocation. So you have certain partnerships with managers that employ tactical asset allocation as part of their process, and those underperformed relative to the benchmark for the year, and so that resulted in a 9 basis point loss. We view TLPM as certainly still in the ramp-up phase. It's really been only 2 years that we've been reviewing this program. So with long-term view, we don't look at that as a material impact in terms of the 9 basis points, but it's something that we wanted to factor into our scoring. And so that was one area for improvement that we'll continue to watch. I would also note that in terms of areas for improvement, the firm score, while still kind of at an average ranking, there can still be some room for improvement there as we continue to see stability at the senior level, and we hope that that's the case going forward. I would note that compared to the investment management organizations out there, it's probably not going to be realistic for the firm score to be at an A level at any given point, because CalPERS is always going to be somewhat constrained in terms of what they can do relative to large investment management organizations. For example, being able to give employees direct equity ownership. That's not something that's going to be possible, so that we really try to compare you all to a large investment management organization. So just in conclusion, 2 years into the process, Wilshire views the build-out of TLPM in a very positive light. The functions of the team continue to expand, consistent with the overall vision of the new CIO. The team is well-staffed to handle the expansion of duties, and as long as there is strong and clear communication going forward with regards to the role of TLPM, we think it's positioned to add value over the long term. So with that, I will stop and see if there are any questions.
Thank you. Mr. Jones.
Yeah, thank you, Mr. Chair. Thank you for your report. And while you indicated that the Wilshire views this expansion as a logical next step, but you go on to say that this has created some uncertainty within the existing team about the role of the TLPM. Could you expand on that?
So in our discussions with staff, it was noted that some of the projects that they were previously working on had been put on hold as some of the vision and some of the focus for this overall total fund performance focus was implemented. So that affected some of the existing projects that the TLPM team was working on. So that was this uncertainty that I was alluding to, that there was a discussion about when those projects would be restarted. So we don't really view it as a material level of uncertainty, but as I said, with any level of change, there will be some uncertainty as people try to understand what their roles are within the team going forward. And so it's not material in nature, but we wanted to address and highlight it as one of the things that we found in our discussions with staff.
So as you go forward, is that something that you would continue to be looking at to assess
yes,
whether
absolutely.
it's deteriorating?
100%.
All right, seeing no other requests. Anything else? It's on.
Good afternoon, Rose Dean, again from Wilshire Associates. I will be going over our program review for the opportunistic strategies. Ali just finished describing the changes in score for the TLPM from last year. So unlike other programs, this, for the opportunistic strategy program, this was the first year that we have scored or given scores for this program, because this program was launched in 2017, and this past year was the first full year that it was in place. So we didn't have a score last year. Our review last year was an abbreviated version with no official scoring. This year, we have provided a score of 4th decile for opportunistic strategy program as a relatively high rating, given the fact that it's still in a build-out phase. And going forward, what we will be focusing on in future reviews will be how the full build-out of the program will be implemented. But just to give a little more detail about the program, given there are some new board members here, there are 3 main sub-strategies within the opportunistic strategies program. So the first is the execution services and strategies. So this is the centralized trading hub for the entire CalPERS investment office. The function or the goal of the ESS team is to reduce operational risk by having the execution be siloed in asset classes, as well as to increase efficiencies, any efficiencies that could be had by pooling all those or centralizing the trading executions across different asset classes. And they also manage the SEC lending and also support the TLPM team in the leverage and liquidity management initiative. The second portion is the enhanced beta team, which Kevin, the MID of the program, mentioned. And this is that low liquidity but short-dated, relatively short-dated investment opportunities that provide enhanced returns within this program. The third part, which is the portion that I mentioned has not been fully built out, which is the truly opportunistic part of the program. And these are opportunities that present themselves across asset classes where there may be some structural anomalies in the market or there's a meaningful dislocation in the market. And then the opportunistic strategies will be funded across asset classes where you can really enhance the total fund risk-adjusted return profile. So that is still being built out. So our review really focuses on the first two portion of the Opportunistic Strategies program. A few highlights in our scoring here. The firm score is same for this program as across all the programs. And Ali had alluded to that score. The team for the OS program, the score is very high. It earns an A rating. The team makeup has been relatively stable throughout the time, given the fact that it's still ramping up and things are still in flux. We give credit to the fact that the team has remained stable, and also they bring deep experiences in relatively, in each sector of the program under the guidance of the MID. So we rate that score very high. On the investment approach, which includes information gathering, forecasting, et cetera, all of those scores are relatively high, but in particular, we gave a high score to implementation. And that has to do with what Kevin also mentioned in terms of the effectiveness of the ESS team and their participation of transitioning the asset allocation to the new targets, and particularly on the high yield side, as Kevin mentioned. So at times through this process, the team was sort of stretched in its resources, but it also provided an opportunity for them to really work across asset classes and really solidify centralizing that trading hub practices and capabilities. So we rate that relatively high. In terms of the overall effectiveness of the program, once I think there are a lot of initiatives that we talked about in terms of total fund focus. So as this total fund focus is going to, part of that initiative is setting up a centralized research and strategy group, and we believe that the success of the opportunistic program is really related to the success of that group, where people from different asset classes come together, generate ideas, and think about how to efficiently fund those ideas from the total fund perspective, and how the governance of that group can be effectively implemented will affect the success of the opportunistic program overall. So that's what we'll be focusing on in our future reviews. And with that, I'll take any questions you may have.
Thank you. Ms. Oliveros.
Hi, thank you very much. I wanted to understand the correspondence between the deciles and the letter scores.
So this is a Wilshire manager research rating scale. So what we consider to be A would be above third decile for all of the investment management companies and products that we rate. And then the next B rating would be above sixth decile, I believe. Fourth and above would be a B rating.
Just one quick, Tom Tote with Wilshire Associates, just to elaborate on that. The rationale for having the decile ratings and the letter ratings is really just to be the ability to be a bit more granular with the decile ratings, but the A, B, C, and below ratings are just, I think, a little bit more intuitive. And you think about the grades you get in school, A's and B's, pretty good, C, roughly average, and then below obviously needs improvement. So that's the rationale between having two types of scores shown here.
Thank you. Can we go through the rest of the scores? I think that I was given 1 through 6. What about 7 through 10?
I'm sorry?
Assuming it's the full decile spectrum, is it on a 1 to 10 basis?
Yes.
So would 7 and 8 then be a D, and then 9 and 10 would be an F? Or do you not grade below a C?
We do rate below a C.
Yes, we absolutely do, but none of the components here as scored for either of the programs merited that rating.
Thank you.
Mm-hmm.
Thank you, Ms. Yee.
Thank you. And thank you for the continuing work to develop the framework on how we're going to pursue further opportunities. Two questions. One, do you think you have enough resources to do that? Or do we need to actually think about giving you more resources to build out the framework going forward?
So this will be.
I assume that's a question for me. So in terms of resources, I almost wanted to comment on Ali's question. That's a question from Mr. Jones about the confusion in TLPM. So as Rose mentioned that we're creating a new group, the Research and Strategy Group, and that group is really to further, as you'll see in the TLPM program review, the only areas market rated as C is our ability for forecasting. So in order to beef up that capability, we're creating another new group, the Research and Strategy Group, which is really to focus on our forecasting ability and also to facilitate the centralized total fund approach in terms of allocating risk budgeting. So I almost wanted to say that source of confusion, quote unquote, was really from us, from me, particularly because we're creating a new group. And when we're making changes, naturally there will be some period of unsettling issues where we're working through these issues. Now, directly back to your question, do we need more resources? Yes and no. So the yes part, we need the right people for the right function. So we're currently looking internally. Kevin Winter, again, the MID of Opportunity Strategies, strategy group has stepped up to be the interim head of the new group. And so we're looking internal talents from the macroeconomic research and down to the asset class research and then to the governance. How do we make investment decisions? How do we monitor investment decisions after they're being made? And how do we hold people accountable for the investment decisions? So these all fall under the new group and the functions that somehow we overlooked in the past. So we'll need some resources. We're looking from internal first, and at some point we have to go out to find the best talent that we can find to come to Sacramento to work for CalPERS.
Yeah, okay, good. And then what's the likelihood for any additional opportunities over the next 18 months or so, given the increased market volatility?
Very good question. We normally, when there's market volatility, we see market dislocation. There's some opportunities. So we're trying to foresee potential opportunities and get ourselves ready, both in terms of a governance, investment decision-making framework, and also the liquidity. So making sure when this happens, we can identify these opportunities, and then we can react to these opportunities quickly. So these are all part of our drawdown and liquidity management plan. Mm-hmm. So we do foresee some opportunity. For example, when the crisis comes, usually the distressed shows up in the credit market, and we're trying to prepare ourselves to take advantage of the distressed credit opportunities when the opportunity comes.
Okay. Good.
And I would just make one additional comment. From our discussions with the staff, with the creation of this new centralized research and strategy group, what we think is important is how people or resources from different asset classes will work together and make it a collaborative effort to really identify where these opportunities may come in the market dislocation.
Good, thank you.
All right, seeing no other requests, anything else on this item? All right. Moves on to item 11, information item on independent oversight. 11A, the review of the survey results of independent consultants. Ms. LaMancha.
Okay, thank you, and good afternoon, Mr. Chair and committee members. Kristen Lamantia, CalPERS team member. I'm here today to go over the annual evaluation survey results of your board investment consultants. As stated by Mr. Fechner, shown in the agenda item, the Enterprise Strategy and Performance Division, or ESPD, acts as a neutral third-party administrator of the board investment consultant surveys. The questions asked this year are the same as in previous years. The number of committee members responding to each consultant group survey were varied. For Wilshire Associates, General Pension Investment, we had 9 responses. Both of the Pension Consulting Alliance surveys, Real Estate and General Investment and Responsible Contractor Program, 8 responses. Makita Investment Group, Infrastructure, 8 responses. And Makita Investment Group Private Equity Survey, there were 10 responses. For comparison, we have displayed the survey results for both 2018 and 2019. I would like to take a moment to highlight a survey calculation example. May I ask you to turn to slide number 6 of your attachment, which is Wilshire Associates, question number 1. As a reminder, this year there were 9 committee members that responded to this survey. In 2018, 10 committee members responded to this survey. I'd like to provide the committee member equivalent to the percentages you see listed here. So for question number 1, accurately analyzes issues and provides timely and objective information. The blue bar chart represents 2018. 50% or 5 committee members rated very satisfied. 30% or 3 committee members rated satisfied. And 20% or 2 committee members rated neutral. For 2019, which is the gray bar chart, we have 56% or 5 committee members rated very satisfied, 33% or 3 committee members rated satisfied, 11% or 1 committee member rated neutral. When considering this specific question, this year 89% of board members who took the survey rated very satisfied or satisfied. Last year the percentage was 80. The comprehensive results for all consultant group surveys are included in your materials in the form of charts representing the various answers selected by participating committee members. With that, I will pause and ask if there are any questions.
There are none.
Thank you.
Anybody? Nope. Okay. All right. Thank you very much. Job well done. Oh, we have one now. Late bloomer, Mr. Jones.
Thank you. Let it come back. This is just to get your thoughts on interpreting data as a result of the changes in the makeup of the board. I don't know, maybe 5 of these responses were new members to the board with a very limited period of time and didn't have the benefit of seeing the changes from the prior year, et cetera. What are your thoughts about interpreting data when you have that kind of turnover among your base?
So comparing different response rates year over year, is that kind of what you're asking? So industry standard for benchmarking dictates that the majority of respondents are participating year for year. And so that provides the confidence that the data and the opinions are in the majority. I do understand that there is a different makeup of the board, so that probably dictates into the response rate of where we are in it. Hopefully next year we'll have a greater response rate for the questions.
Okay, thank
you. Mr. Miller.
This also relates to the response rate. I've noticed on a few of the surveys, not just this one, we pretty consistently will have 2, 3, 4 or more members who do not participate on this board. And I want to challenge my fellow board members. This stuff is important. If 3 or 4 people didn't participate because they were unhappy with our consultants, that would be a huge information gap that we don't have when you don't take a few minutes and do these things. So please, let's all challenge ourselves to provide the feedback. That's part of our job. We need to do it. Thank you.
Good point. Thank you, Mr. Miller. We have another one now. Ms. Brown.
course, I did my survey, but we did have quite a few new board members and didn't feel confident expressing their opinions. And so I don't know if there's a slot for that, or maybe they would just put neutral. But I do know that we had many new board members that didn't have enough experience, and so that's why they didn't participate. But I do agree with Mr. Miller. There are other times when everyone's been here and could have given their answers, like to Ms. Hopper's surveys. So, thank you.
Thank you. No other requests. Thank you. Brings us to item 12, summary of committee direction. Mr. Meng?
Yes, Mr. Chair. So I noted down two. One is from Ms. Middleton on the housing market, region by region. And the second one is from Ms. Olivares on the benchmark of the cross-asset volatility premium. So those are the two items, follow-up items that I noted.
All right, thank you. Item 13 is public comment. First one we have is Mr. Neil Johnson.
Neil Johnson, SEIU. The other day, I was reading agenda item 10A, which dealt with the total fund investment policy, and there was a discussion of staffing and the support staff, and there were what looks like 11 seasonal clerks. Mr. Fechner and Mr. Jones, I think, are the only two that were here when we went through the CalPERS build up and the problem with Accenture, but you wound up having to hire a bunch of temporary employees to handle workloads in that process. And then seeing these seasonal clerks made me wonder, so I looked back at records and find out that this board has roughly 100 seasonal clerks. That is more than, or only the Franchise Tax Board, which has a sort of classic tax season, hires more of these employees. These are temporary employees. We are supposedly a long-term fund. We had the gentleman from STRS that made the comment that PERS is their investment vehicle. Yet you're hiring temporary employees who do not get benefits unless they've acquired them from some other appointment. And it's sort of amazing that you are have the second largest number of these temporary employees in the system. Thank you.
Thank you. Okay. Now, we do have a number of requests, I assume all on the same topic. I want to remind you all that we're butting up against the court reporter's mandated time, so we're going to implore him to maybe go an extra 10 minutes longer than his normal time, and I think we can push through this. But please, you can all be as concise as possible, not repeat one another. That will certainly help in the process. The first one I have is Emily Goldman.
Are we not doing a few people at the same time?
Pardon?
Are we not doing a few people at the same time?
I'm going to do you first. And then I understand there were a number of them that just wanted to speak their name for the record. I'm going to have them come forward and put their names in the record, and then we'll go through your speakers.
Okay. So my name is Emily Claire Goldman. I am the founder and director of Educators for Migrant Justice, as many of you know. Want to start out by saying welcome to the new board member, and thank you all for your continued engagement and attention to the important issue of CalPERS investments in for-profit prisons and other companies involved with the immigrant abuse crisis that is currently ongoing. Just to give a short recap of what's been going on since the last board meeting, Core Civic and Geo Group stock prices have plummeted more than 30%. and that's a 2-year low, while the S&P 500 has risen over 20%. So that means that they have both underperformed the market by nearly 50%. Since last month's board meeting, more banks have pulled out and committed to no longer providing any more loans to these companies. That now includes JP Morgan, Wells Fargo, Bank of America, SunTrust, BNP, Fifth Third Bank, with PNC and Barclays both stating they don't plan to provide any future loans. These 8 banks account for more than 87% of CoreCivic and Geo Group's term loans and lines of credit. And this increasingly restricted access to capital recently led Fitch's rating agency to downgrade CoreCivic from BB+ to a BB. CoreCivic and Geo also recently lost sell-side coverage, while Vanguard, Geo's largest shareholder, announced they will be pulling Geo from their ESG funds. In the latest SEC filing, CoreCivic admits that the decisions by some of the company's largest banks have affected their capital markets for their securities, and that this could have a material impact on their business, financial condition, and results of operation. Geo, in their latest filing, acknowledges similar risks, and for the very first time, notes the potential adverse impact to its share price. Geo is now calculating the fair market value of its stock options, assuming a stock volatility of more than 40%, which is rather large. On top of that, while in past SEC filings, Geo has discussed the 3 class action lawsuits they're currently facing, their most recent filing admits that they may not actually have insurance for any of the employment-related claims, which are the basis of those 3 class action lawsuits. And I cannot underscore the risk that that poses. One of those class action lawsuits represents 60,000 people. Moreover, in the latest SEC filing for CoreCivic, they are actually boasting about the fact that privatization of U.S. prisons, quote, allows governments to avoid long-term pension obligations for their employees. That should raise concerns considering CalPERS is concerned with their funding status and having funding drained that would otherwise be going there. Last but not least, I would like to remind the board that we are also looking at other companies, including General Dynamics. I know there's been a significant change in your holdings in General Dynamics, which is providing contracting services for the Homestead Child Detention Facility, and it's important to follow up on that.
Thank you very much.
Thank you.
Now, if those of you that are only going to put your name into the record, could you please come forward to the microphone and give us your name and your affiliation?
Good afternoon, board members. My name is Peggy Bernardi. I'm a member of CalPERS, and I'm going to say one thing in addition to just my name and my support of what Claire had to say. I retired recently from DWR after working there for 26 years, and I am a CalPERS member. I urge CalPERS to sell its holdings for the for-profit prison companies, CoreCivic and Geo Group, and to use their leverage to pressure General Dynamics and United Rentals to provide access for redress to those adversely impacted by their operations and to end their material support for the detention of migrant children and families. I would like to remind you, my feeling is that investing in these companies with knowledge of their role in the migrant abuse crisis makes CalPERS and its members complicit in these activities, and I urge you to take action to stop these investments. Thank you very much.
Thank you.
Hello, my name is Heidi Sarabia. I'm a faculty member in the Department of Sociology at Cal State, California State University, Sacramento. I have been a CalPERS member since 2014, CFA member, and a member of the Task Force for a Center on Immigration, Race, and Social Justice at Sac State. And I also encourage you all to consider divesting from migrant detention centers. It's a humanitarian crisis, and we need to take action. Thank you.
Thank you.
Hello, my name is Marco Segueda. I'm a faculty member at California State University, Sacramento. I'm here to support my colleagues to call on CalPERS to stop investing in CoreCivic and Geo Group. Geo's detention center in Adelanto was particularly notorious for their abuse of migrant detainees before the city of Adelanto ended their contract with this private prison company. I urge CalPERS to divest in these companies because they are destroying families, killing our most vulnerable, causing terrible trauma that will last generations. generations, and these repercussions will be felt for many years to come. Recently, members of Congress documented the inhumane and horrifying conditions of these detention centers, noting that detainees were forced to drink water out of toilets, noted psychological abuses, and in most extreme cases, migrant prisoners have died under these conditions. CalPERS investment in these companies reinforces and legitimizes the dehumanizing treatment of immigrants. Each day that you continue to invest and empower these companies with the funds of public employees, you are actively complicit in these atrocities. For these reasons, I urge you to divest now. Thank you.
Thank you.
Good afternoon. My name is Marlon Jones. I'm a professor in the Division of Criminal Justice at California State, Sacramento, and I've been a member of CalPERS since 2001. I'm here in support of my colleagues to call on CalPERS to stop investing in CoreCivic and Geo Group. Thanks.
Thank you.
Good afternoon, members. My name is Alex Coyce, and I'm a staff member at CSU Sacramento. I've been a CalPERS member since 2016. I'm also here representing membership from the Queer Trans Faculty and Staff Association at Sacramento State. And I'm here to urge you to please stop investing in CoreCivic and Geo Group. Thank you.
Thank you.
Hi, good afternoon. My name is Jessica Lawless. I work for the California Faculty Association. My spouse is a cook at UC Berkeley and has been a member of CalPERS since 2014. I am here in support of my colleagues, neighbors, and friends to call on CalPERS to stop investing in CoreCivic and GeoCorp.
Thank you.
Good afternoon. My name is Janet Rodriguez. I'm here with the California Faculty Association in support of my colleagues, asking the board to stop investing in Geo Group and CoreCivic.
Thank you.
Hi, my name is Sharon Flicker. I'm a faculty member at CSU Sacramento, and I've been a member of CalPERS for 1 year. I'm also here to support my colleagues to call on CalPERS to stop investing in CoreCivic and the Geo Group. As a clinical psychologist, I really want to emphasize the traumatic and long-lasting effects of separating children from their caregivers. Thank you.
Thank you.
Good afternoon. My name is Miriam Jaffe-Block. I'm a manager at the California Alternative Energy and Advanced Transportation Financing Authority in the State Treasurer's Office, member here in my individual membership capacity, supporting the folks who spoke previously and supporting divestment from CoreCivic and GeoCorp. Thank you.
Thank you. Now I'll go through what I think I have left on my list, and if I call you, please come forward. Joanne Fanucci, Ruth Ibarra, Greg Brucker. Any of them? Oh. Remind you have up to 3 minutes to speak, and please give us your name and your affiliation.
Good afternoon.
You can sit at the other two microphones. They're lit up.
Pardon?
I'm telling the other two people behind you they can sit in the other two microphones there.
Okay.
Thank you.
It's lit up when it's red?
Correct. Means it's on.
Shouldn't it be green? Okay. Anyway, excuse me, I'm wearing sunglasses because I forgot my other glasses. Okay, so no offense. My name is Joanne Fanucci. I'm an independent ally of a lot of environmental groups in the Bay Area to stop all that. But I am here today to stand with Educators for Migrant Justice and NorCal Resist and all of the babies and all of the families at the different borders, okay? Now, I've been up here, I don't know, 6 times already, and not just about this, but about fossil fuels. I'll see you in September. But I wrote, after the last meeting, I emailed the board and again reiterated my stand with these two organizations who are pushing so hard to make you see the light. Here's the response I got. I may be preaching to the choir with some of you, but I feel it needs repeating. This is your response. Thank you for taking the time to write to us and for sharing your concerns. We do hold shares in both CoreCivic and GEO Group and others. We've expressed our concerns with the issues you raised in your email and continue to actively engage with both companies on several
fronts. At CalPERS, we believe that engaging with companies is the most effective way to change policies and behavior that can impact financial performance. Divesting from these companies would require us to give up our voice at the table and sell our shares to another investor who may not share our values. Your values are murdering people. We want you away from this table. This is the same response that you gave fossil fuels last year. This is the same exact response that you've given us before. You are not moving on this. You are not understanding. You're denying. We exist. These people on the borders exist right now. There is no more time. I don't know what I have to do or what anybody has to do to get you guys out of the process you're in and try something new. Now, okay, so that's enough of that. Last time I was here, I asked you to please provide us with a chart, risk and reward. How much risk are you guys willing to take? How many people have to be injured, have to be abused, have to die of neglect of medical care before your rewards outweigh that? How many? How many children? I didn't get the chart. I left you my email. This is what I got back. You're negligent in your duties. We are telling you, this is what has to happen. Your stocks are already going down. It's a sinking ship. Wake up. Thank you.
Good afternoon. My name is Ruth Ibarra and have been a CalPERS member for 12 years. And I'm also a local activist helping asylum seekers who are being released from these concentration camps. I see the trauma that they've gone through on a daily basis. I'm here today to demand that the use of my retirement funds be immediately divested from companies that are profiting from the immoral act of caging people. Individuals have died. Children have died. Trans folk have died. Our most vulnerable members of our community at these concentration camps. And thousands of children and women are currently reporting mass abuse, sexual abuse. Investing in companies such as Geo Group and CoreCivic is complicit with these heinous crimes against humanity. It's time for CalPERS to stop putting profits over people. It's time to divest from corporations that treat people as disposable objects. Stop putting blood on CalPERS. Stop putting blood on CalPERS members' hands. Enough is enough. You must divest today. Thank you.
Good morning. My name is Greg Brucker. I am here independently. I first want to thank you for the time. I am a CalSTRS member. I am a teacher in our K-12 system in this state, and I strongly demand you to follow in the suit of CalSTRS in divesting from even putting 1 penny of the general public's money into investing in child prisons, family separations. I am also here with representing Jewish Action NorCal, a group of Jews from the larger area who demand that these camps are closed, that this government stops treating our refugees and immigrants, also known as our ancestors if this were another time, in a way that we find morally appalling and that we see as very much along the lines of what happened before the Nazis started their death camps. We see it very clearly. Families were separated, people were put into camps, and you know what? A lot of the people that died, it wasn't because they were gassed. It was because they died of disease, of poor conditions, of the fact that they were denied the ability to keep themselves clean and be given basic things like soap, as is happening right now. And we despise the fact that there is money from any public sector supporting even 1 penny of investment into groups that do this, that have directly led and are making money off of the backs of these children dying, families being separated, people that just a few years ago would come to our country for to be as refugees because of the horrible things they're dealing with in their country. And when did we stop caring about those people? When did we stop saying that those people don't matter? Would you have said that about the Jews in the 30s? Because that's what you're saying about these people now, no matter where they're coming from, that it don't matter. They just instated in the federal government a public charge rule. This goes right along with it. That led to people being denied the ability to come into this country who were subsequently then killed in the Holocaust. How many people have died because of the fact that money is being invested in companies which are creating these camps, which are making people either leave or want to not come here or be turned away, as we know lots are, that are then dying? Is that what you want to fund? Is that how you want to take care of the people's money? Because that's how I see it working. Thank you very much for your time.
Thank you. I have Margarita Berta Avila, Maya Dosh, and Melanie Sake. I only called 3. How do we get 5?
5? Just for support. Just support. Tell me.
Go ahead.
Okay. Good morning. I am Margarita Berta Avila, and I'm a professor of education at Sacramento State University, as well as a proud member of the California Faculty Association. Our union collectively serves as the voice of the California State University systems, more than 28,000 professors, lecturers, librarians, counselors, and coaches. And I'm here on their behalf to advocate on the topic about which we are unequivocally united: your continued investment in CoreCivic and GEU Group, 2 of the largest corporations in the private prison industry, as well as the operators of the largest migrant detention centers in the country. This marks the 3rd consecutive CalPERS board meeting that CFA representatives have attended during the last 3 months. Previously, you heard impassioned comments from my colleagues, but those appeals have unfortunately yet to make a difference. That is why I have 200 of these postcards that I am hoping to submit to you today after I speak, with hundreds more on the way from CFA members at our 23 campuses statewide. We want you to hear us loudly and clearly on this matter. As you know, the political climate in our nation has developed into a bottomless pit of hate, fueled daily by morally bankrupt leaders whose only goal appears to be to take Americans further down this black hole. Mirroring this dynamic in CalPERS' continued investment in CoreCivic and GE Group, whose business models are based on the caging of children and the tearing apart of families. But I do not have to tell you about it, because like me, you have read the heart-wrenching stories and seen the dreadful footage capturing the savage tactics that private prisons employ at our southern border. They are human rights abusers on par with the most corrupt and villainous regimes around the world. If CalPERS was a private investment firm, I would still be here today to speak out on this issue. The frustrating reality, though, is that your investment in these corporations is being done with the pension funds of CFA's 28,000 members, as well as those of roughly 1.4 million other public employees. Your isolated decision to continue investing in CoreCivic and GE Group has made us all complicit in this unethical venture. As a teacher, I take heart the enormous responsibility I have in the classroom. It is a privilege to play a part in the intellectual development of succeeding generations of leaders. But tell me this: how can I look my students in the eye with even a shred of integrity when my pension, which is paid in part of their tuition dollars, is being used to sustain businesses that perpetuate such callous atrocities? I can't. As 19 years CalPERS member, how can I look at you in the eye, not only for initially making this investment, but for also failing to stop it? Finally, as a compassionate person, how can I look at myself in the mirror knowing that some percentage of every dollar I earn per hour, per day, per week, per month is enabling this corporate campaign of abuse? I can't. Like so many other times, the country and the world are looking to California for leadership that resists and inspires on the host of issues. Thank you.
Good afternoon. My name is Maya Dash. Thank you very much for your continued engagement. I'm a CalPERS member in my role as an assistant professor of art at Sacramento State. And I'm here on behalf of 66 Sacramento State faculty and staff and CalPERS members who make up the Queer and Trans Faculty and Staff Organization on campus. Last month, our board, with the support of our membership, voted to urge you all to not invest our retirements in CoreCivic and Geo Group. We are collectively appalled by the human rights abuses committed by these corporations against all migrants, and we're particularly motivated by those against our LGBTQ siblings. There are at least 5 transgender women in our Sacramento community who were incarcerated in CoreCivic's Cibola prison. All of these women are here legally with strong asylum cases. The women survived horrific violence for being LGBTQ in their home countries, some with gunshot wounds or scars to prove it. They escaped the United States to save their lives. Yet, the word Cibola is still spoken among them in hushed tones, as it is synonymous with systemic abuse, punishment, and disrespect for their basic rights as human beings. These women witnessed so much violence and abuse in their home countries, but their time in Cibola stands out as among the darkest periods of their lives. CoreCivic actually lost its Cibola contract with the Federal Bureau of Prisons in 2016 due to medical and safety failures. This is exactly when ICE swooped in with its Cibola contract. And these CoreCivic medical and safety failures killed transgender woman Roxana Hernandez last year. She died because of medical neglect. Treating her would have cut into CoreCivic's profits, so they didn't treat her. These vulnerable LGBTQ people come to the US in hopes of escaping violence, and instead found worse violence at the hands of a US corporation. So we, as queer and trans CalPERS members, in solidarity with LGBT members of our community, demand that you use your power to take our money out of these corporations. Thank you.
Thank you.
My name is Melanie Sake. I am a staff member at Sacramento State University. I'm also the logistics coordinator for queer and trans faculty and staff who, of course, voted for the divestment cause. We're appalled at the conditions, the overcrowding of cells, detainees sleeping on bare floors without real bedding, lights kept on at all times, almost no access to shower or toothbrushes or toothpaste, which were confiscated from the detainees upon their arrival, grown women being told to drink from the toilets, inadequate amounts of food, children separated from parents, children having to represent themselves in court without support or guidance from lawyers or parents, babies who soil themselves and are not given clean clothes or diapers, trans women, in many cases, being detained in men's facilities. In one case, a trans woman detainee reported being literally chained up in a men's facility for hours. Or, of course, there's Cibola, in which case there was a letter signed by 29 refugees imprisoned there, talking about the verbal and psychological abuse that the guards perpetrated against them on a daily basis. This letter was signed by asylum seekers from Central America primarily, and they reported that there was no adequate medical attention for people with disabilities, HIV, people with skin infections that they acquired in their detainment, and lack of medication overall, which of course I remind you that asylum seeking is not a crime. Trans women across the board were not given razors for their basic dignity, lack of medical care across the board, lack of hormones for trans detainees and other crucial medications for all of the detainees, asylum seekers, and refugees. Several detainees, including children, are transferred to hospitals only after they are so sick that they die almost immediately upon arrival. And there have been recent reports that the camps are becoming work camps on top of this, where detainees are being forced to work for almost no money. These conditions are concentration camp conditions. I come from a Jewish family, and my PhD research focuses on mid-20th century history, so I have extensive knowledge of what constitutes a concentration camp. We currently have concentration camps. These are not Sac State's values. I truly hope that these are not your values. This is why I'm strongly urging CalPERS to divest from the concentration camps. Thank you.
Thank you. All right, next I have Maria Vargas and Alex Cole-Weiss.
We're just going to stay with her for support as Maria speaks.
Okay.
Yeah, here's.
Yes, good afternoon. My name is Maria Vargas. I'm here representing the Center on Race and Immigration and Social Justice. It is important to humanize migrant children and families who are often dehumanized in the news, where their brown, suffering bodies are sensationalized through the camera lens for the voyeuristic gaze of American society, who does not understand why they are here. Darlene Cristal Cordova, Jacqueline Cal, Felipe Gomez, Juan de León Gutierrez, Carlos Hernandez, Wilmer Jose Ramirez, who is 2.5 years old. All of these children, 5 from Guatemala and 1 from El Salvador, have died in federal custody since September 2018, 3 of them from the flu. The deaths of these children have resulted in outrage from human rights groups and lawmakers who denounce the inhumane condition and medical neglect in detention centers. Earlier this month, doctors wrote a letter to Congress calling for an investigation into health care at the border. The doctors stated, quote, "We suspect that the Department of Homeland Security may not be following best practices with respect to screening, treatment, isolation, and preventions of influenza," end of quote. However, even with the advocacy of immigrant rights groups, Congresswoman Alexandra Ocasio-Cortez, and reputable doctors that challenge the normalization of children dying at our borders, many Americans blame the parents and criticize them for fleeing with their children and inserting them into dangerous situations. However, according to recent studies, El Salvador, Honduras, and Guatemala, known as the country of the Northern Triangle, account for the highest homicide rates in Latin America, as well as the most murderous countries for feminicidios, or the killing of women due to their gender. In 2011, in El Salvador alone, 524 cases, and Honduras, 466 femicides, where women's bodies were found mutilated and tortured with signs of sexual assault, were found. Feminicide not only targets adult women, but a larger percent of victims are actually girls under the age of 15, which is why many fathers and mothers fleeing from the Northern Triangle say that during these times they would never leave their children behind, especially their daughters. What Americans have failed to see is that the Central American state or government has failed to protect their most vulnerable: children, women, indigenous people. 5 of the 6 children that I read, 5 of them are indigenous children, Maya children, who the Guatemalan state in 1984 committed genocide against with the help and intervention of the CIA and the US government. Again, these the other salients are not salient factors are race, ethnicity, and poverty, right? I again, with my colleagues, urge you to divest from these genocidal companies. Thank you.
Anyone else that did not call down yet? Very good. We'll
to submit the 200 cards.
Pardon?
We have the 200 cards that from our faculty from CSU across the state to submit to you all.
Okay. Just hand them over here to staff, please. We thank you all for coming and for your comments today, and understand that we take your concerns as serious as you do. We're looking at it through different lenses, but you will see some action at some point in time. We are addressing the concerns. So we thank you very much, and that adjourns the open session meeting. Closed session will begin at 2 o'clock.